Please join Mindy Bartley, the Eastern Regional Processing Training Manager, during this session where she will cover income calculation options for processors. We would like to advise this training is for income calculation and data entry into FT360 before a file has been submitted for initial underwriter review. Please remember, once a file has been decisioned by an underwriter, no data on the 1003 should be changed by the branch, and no updated AUS should be run by the branch without direct authorization from your underwriter. Remember to follow your AUS findings and/or your underwriter conditions to document income in your file. Any additional non-required income documentation that is located in the file will be reviewed by your underwriter and may result in additional conditions. In this training, Mindy will be using PRMG's Income Calculation Worksheet. You can obtain this worksheet from PRMG's Resource Center, which you can access from a link in FastTrack 360 or from the Product Profiles and Resource Center link on PRMG apps as shown here. Once you're in the Product Profile and Resource Center links page, go to Retail Resource Center Forms, then from there, press Ctrl F on your keyboard and search for the Income Calculation Worksheet. This will bring you to the link to the form. Next, simply click on the link and it will download the Excel file.
Income calculation and data entry into FastTrack 360. This information is meant to be a basic guide to assist you. Please always refer to the PRMG Resource Center for current policies and procedures. Let's take a look at an income calculation worksheet. You'll notice it's an Excel spreadsheet, and there are various tabs across the bottom of the sheet that you can click on and go from form to form. We're going to take a look at income calculation option 1. Option 1 should be used for those wage earners that are salaried or that are hourly but work the exact same amount of hours from pay period to pay period without fluctuation. These wage earners should also not be receiving any overtime, bonus, or commission income or any other additional types of income. So for income calculation option 1, we're going to enter our income calculations in the gray area over on the right. We'll put an X next to the income type. Our test file today, Andy America, is a weekly wage earner. And then we're going to put his dollar per week here. So we're going to say he's $600 a week. And you'll notice that it will calculate the annual amount over here on the right in the total column. It will also calculate a monthly earning over on the left side. So his monthly earnings are $2,600 per month. Be very careful regarding the income type and understand how to read your borrower's pay stub. Please note there is a difference between biweekly and bimonthly. Biweekly is a pay period every other week, 26 pay periods in a year. Bimonthly is a pay period twice a month, which is only 24 pay periods in a year. Let me show you a sample pay stub. To figure out your borrower's pay period, please refer to the period start date and the period end date. In this example here, I can see that my period start date here was 9/16, my period end date is 9/30. You are not going off from the pay date of 10/1. If I look at the prior pay stub, I can see the prior pay stub was from 9/1 to 9/15 of 2018. So this example would be bi-monthly. So let's continue on to Andy America. We're going to complete his year-to-date 2018 earnings. It's extremely important that the from and to dates are correct in each section. Andy America started his job with Sunshine Ace Hardware on February 1st, 2016. Okay, so let's go ahead and plug in the figures. So year-to-date 2018, he's made $24,600. The prior year, $28,000, and the year before that, $28,800. Your underwriter is going to review the various income calculations to see if there's anything here that needs to be explained. So I can see current year to date, his average is $2,617.02. That's pretty much in line with his monthly calculation of $2,600. 2017, his monthly income was around $2,300 a month, And the prior year before that, in 2016, his monthly income was around $2,600. So I can see here already that there's something that may need to be explained in 2017. It is your job as a processor to make sure that you're able to tell the full complete story to the underwriter. There is a note section at the bottom of the income calculation worksheet. It's there for you to use and to be able to explain to your underwriter what is happening during that time frame. Well, in 2017, there was a hurricane that hit Florida, Hurricane Irma. The employer was closed for the month of September due to hurricane evacuation and repairs, but the business is back on track, and we can show borrower pay stubs to show income stability, and we had a note added to the verification of employment from the employer to confirm that the business was closed due to the hurricane. So if you have a valid explanation and you're able to support the current monthly earnings, that's what the underwriter is going to be looking for. Let's go to income calculation option 2. Option 2, you'd want to use if the borrower's pay fluctuates from pay period to pay period, and also if the borrower's earning additional types of income such as bonus, overtime, or commission. So in option 2, let's pretend that Andy America is an hourly employee. So we're going to say he makes $15 per hour. Again, the from and to dates are very important. We'll add our year-to-date earnings here and the number of hours. Now, it's important to note when you're filling out this option 2 form, this hourly portion or salaried portion down here, if the borrower is salaried, would be base income only. So you do need to split out your base income from any other income type that they're receiving, such as bonus, overtime, or income, or perhaps if they're in the medical field, it could be shift differential. So there is a spot here for W-2s for tax years, for prior tax years. Again, keep in mind, you're actually not putting the W-2 amount there, especially if the W-2 includes some of those other types of income. You do need to split out the base income from the other income types, which is why you typically would gather a verification of employment from the employer. Let's take a look at this VOE, or verification of employment. So here's our test borrower, Andy America. The employer completed it that he's $600 a week, but we have base pay here of $24,600 year to date, and they've broken out that he's been receiving bonus income back to 2016. And we have a remark here that in September 2017, the business was closed for 30 days due to Hurricane Irma. His average hours per week are listed here in box 15. So the average hours per week should match the number of hours listed on your income calculation worksheet. We're breaking out our base pay. You'll notice it will give you some various income calculations here. You have 4 different income calculations. Your underwriter will typically go with the most conservative calculation unless you can support why you should be using a higher amount. So again, your underwriter will typically go with the most conservative calculation, which would be the $24,5794. However, remember we had a hurricane event, natural disaster in 2017. So I'm going to request that we use the $2,600 per month and make a note at the bottom of my verification of employment regarding the hurricane. Now I can go ahead and plug in my bonus income. So I've put in my past year OT breakout for 2017 and 2016 to match my VOE. My current year to date bonus is $1,500. Once I enter my $1,500, and again, make sure that your from and to dates are correct so it does a proper calculation over here in the number of months column, it will give you your averages. Again, you're going to use the most conservative amount, And for overtime bonus and commission income, you do need a 2-year history of having received it, and it needs to be likely to continue. So I'm going to choose the $92.59 per month amount that my income calculator calculated. Now, how do we show these types of income on our 1003? So let's flip over to the 1003 page 2 in Fast Track 360. I have base income showing for my borrower of $3,000. That's likely what my loan officer put on the application based on what the borrower gave them. So I need to make sure that my income calculation totals match what I have on my application before I send it up to underwriting. I'm going to change my base income to $2,600 a month because that's what I can support based on the documentation that I have. And I'm going to plug in an amount for bonus. My bonus income I'm using is $92.59. And that is how I would show my Andy America's income. As we move down the page, you'll see that there is a whole section for commission. So if they're receiving commission income, you will complete the boxes as applicable. Again, make sure that your from and to dates are correct. You'll also notice that there's a section here for 2106 expenses. On your borrower's individual tax return, they may have a Schedule A as part of their return, which are itemized deductions. Here's a sample of one showing on the screen. If you scroll down toward the bottom, there is a section on line 21 for unreimbursed employee expenses. If there is an amount on this line, on this one that's $10,893, you must include that on your income calculator, and it will show up as a loss of income. So it's going to go against any positive income that you have in your application. But it's very important to look for those amounts. The other income section you can use for retirement income. So you are required to still complete an income calculator if you're retired. Our example here is for pension. Now for pension, you can just type in the word pension here. You can go ahead and put in your year-to-date income. So let's say we're $1,000 a month in pension. And let's say through October 12, borrowers made $10,000. Again, it's going to give you some calculation options. For pension, you can use the current amount that they're receiving. So I'm going to use other monthly and check that box. And it's going to populate over here or check the income you wish to use. Now I'm using the monthly amount of my pension based on my pension stub or direct deposit. However, I'm documenting my retirement income. Again, you must go to PRMG Resource Center and double check guidelines. Typically, your retirement income needs proof of continuance for at least another 3 years. There's also a non-taxable income section. This is most frequently used for Social Security, non-taxable. So you do need to confirm that the Social Security that you're plugging in here is non-taxable. You can gross it up by 25%. So I believe this auto defaults to 15. You can manually change it to 25 on the form. You'll go ahead and plug in the monthly check or direct deposit amount. So if you're using Social Security, you can go off from the Social Security award letter and use the monthly amount there. Or if you're going off from bank statements, then it would be the direct deposit. So let's say we have an $800 a month Social Security that we're documenting. You're going to plug in the income from the most current 1099 and then the annual amount of the income that is not subject to tax. You will check the box for the amount that you're using and you'll notice that the calculator will auto-calculate the gross up factor and give you the total amount that you're allowed to use for Social Security non-taxable. So how do you show this on your 1003? So we'll go back to our page 2. In the other income section, we're going to say this is for our co-borrower. You can do B for borrower in this column or C for co-borrower. I have C for co-borrower. The description, there's a drop down. So if we were using pension, we'd go ahead and plug our pension in here and put our $1,000 a month. It would look like that. For Social Security, there's a drop down for Social Security, disability income. It would look like this to match our income calculator. At the bottom of the non-taxable section, there is another section for that 2106 expense requirement. So again, if you are using individual 1040s or individual tax returns to qualify, you must look for the Schedule A if it's applicable, and take a look for that line 21 and see if there's an amount there on that line. Again, if there is, it's a deduction or an expense against your income. Just something to take a look at. Now, let's look at some other income types on the income calculator. Let's go to rental non-owner occupied individual form. So we're going to use this form to calculate our rental income. So let's take a look at lease versus Schedule E. So we have a sample lease here for our borrowers, Andy and Amy America. Our lessees, Tim and Tammy Tennant, for property in Bonita Springs, Florida. So we have a current lease. Here's the original lease. It was extended. And then we also have Schedule E rental income data from the individual 1040. So if you go to your individual tax return and there's a Schedule E attached, this is what your Schedule E would look like. Now you have on your rental income worksheet, you have two options to calculate your rental income. You have step 2A, which is off from your Schedule E, or you have step 2B using current lease agreement. So let's take a look at the Schedule E first. So this will be off the current tax return. And we are going to plug some figures in here. I'm going to do a little side by side. So all we do is we enter in the information in the correct line. Enter total rents received. So we're, actually, let me back up for just a minute. I want to explain on the Schedule E, there is a column for fair rental days. This one's 366. The form auto-populates to 12 months that the property's in service, meaning it's been rented for a full 12 months, but you do need to double check that against the Schedule E data. So you'll take the fair rental days, divide by 30, and whatever figure you get there should be the number of months that the property was in service for rent. Once you've done that, then we're going to go to the total rents received line, which is line 3 on my Schedule E. So I'm going to plug in 18,000. Then I'm going to subtract my total expenses. So if I scroll down a little, total expense is line 20, 24,420. Now I'm going to add back my insurance expense, and you'll see in this column it says add. So I know that's what I'm supposed to do, is add. So my insurance line on my Schedule E is line 9, $731. Then I'm going to add back any mortgage interest paid, $8,030 from line 12. And I'm going to add back my tax expense. So I'm going down here to line 16 to taxes, $2,854. I'll add back any homeowners association dues. Now on this particular Schedule E, it's listed under Other Statement 7. The 2009-44 is the HOA. You wouldn't want to just assume that though. You would actually need to go, if it said see statement 7, look at statement 7 attached to the tax return and make sure that that's what that expense was for. You're going to add back any depreciation expense or depletion. So my depreciation or depletion line on my Schedule E is line 18, which in this case is $9,074. And then I'd add back any one-time extraordinary expense, which would be a casualty loss. I didn't have any of those on this particular Schedule E, so I'm going to skip that line because it doesn't apply to me. It's going to auto-calculate an adjusted gross rental income divided by the number of months and give me a monthly rental income here. Then I'm going to subtract my proposed PITIA. So that's going to be my mortgage payment plus any additional debt, such as my homeowners association dues. So if I go back to my 1003, page 3 in the REO section, which is real estate owned, click on the Show All VOM tab. Here's my investment property here. I can see my mortgage payment that's tied to this property is $1,000. And on our example here today, taxes and insurance are currently escrowed. So my total PITIA for this property is $1,245. So here's my step 2A. Now, how do I make that match my 1003? So right now I'm getting a net rental income of $189.42. So let's plug in the numbers here. I'm going to take my adjusted monthly rental income of $1,434.42, and I'm plugging it in to my gross rental income line here. Then I'm going to add back in my taxes, insurance, and expenses. Now remember, my taxes and insurance are escrowed into my mortgage payment. So I'm going to go ahead and plug in my HOA. And I'm going to put in my percentage of rental. Now, if I'm using the Schedule E off the individual 1040, my percentage of rental would be 100%. I'm allowed to use 100% of that. My participation would be the amount of ownership that I have in the property. So if I'm 100% owner, I put 100%. And I can see that my net income line on my 1003 is now showing $189. Does that match my income calculator? It does. So let me show you the other method. Step 2B with a current lease agreement. So if I look at my current lease agreement, go back to my lease. I can see, here's my original lease agreement, went from 2015 to 2017. It was a 24-month agreement at $1,500 a month or $18,000 a year, which is what we just saw off the most current Schedule E, $18,000. However, the tenant has since signed an addendum to the lease agreement agreeing to pay $2,000 per month for the next couple of years through 2020. So if I want to use current lease agreement, let's go back to our calculator here. We're going to enter the gross monthly rent. You'll notice that if you're using current lease agreement, it's at a 75% multiplier. It's going to adjust the monthly rental income by the 75%, and then we're going to subtract our PITIA. So now I have $255 a month positive. How do I show that on my 1003? So how I'm going to change this is I'm going to change my gross rental income to the $2,000. I already have my mortgage payment listed here of $1,000 plus my $245 HOA dues. So I have a total of $1,245 debt, which matches this line right here. My percentage of rental, however, needs to change from 100 to 75. I'm still 100% participation. And now my net income is showing $255, which matches my income calculator. So you can see here between 2A and 2B, which method is better to use in this case. In this case, current rental agreement is probably better to use. The net rent income, the $255 from our 2B, is going to calculate here in the net rent section and populate over to the 1003 page 2 in the net rent section here under gross monthly income. So that's rental income. Now let's continue on to a Schedule C demonstration. So Schedule C is considered self-employed. You have an option to use the income calculator or to use LoanBeam, which is a service that we use, and LoanBeam will auto-calculate your self-employment income for you. I'm going to show you that in a little bit. But Schedule C income worksheet is actually very, very easy to use, so I'd like to demonstrate that for you as an option. So let's pull up. We have 2017 and 2016 Schedule C returns. These are located within the individual tax returns for your borrower. If they have filed a Schedule C, then they will look like this. This one's an amended for 2017, and then here's the regular one for 2016. On the Schedule C income worksheet, you'll notice that there are line items showing on each line. These line items correlate directly with the Schedule C line numbers. So all we're going to do is go to that line number and plug in the figure that's listed there onto our calculator. So again, very, very easy to use. So the first thing that you need to do is fill out the top part with your borrower's information. You need to make sure that you have the proper years listed here. Okay, so you can auto change them and you'll see they'll switch. So make sure that you have the correct years there. You're going to put an X here for to know if the borrower owned the business in that particular tax year. And then we're just going to plug in the figures. So let's do 2016 first. So I've got the Schedule C up on the right side. The first thing I'm going to do is look for line 31, net profit or loss. So here's my line 31 down here, 13,927. Then I'm going to look for depletion line 12. If there's nothing listed here on line 12 on the Schedule C, you skip it on the income calculator. So we're going to skip that line because there's nothing listed there on line 12. Then we're going to look for line 13, depreciation. We have 96,000 listed here. And then line 30 for home business use. That line is blank on my Schedule C, so I'm going to skip it on my calculator. Amortization casualty loss, you'd have to see if there's an attachment to the Schedule C that listed it in amortization or casualty loss for the business. In our example today, there is none, so we're going to skip it. Less deductible meals and entertainment, line 24B. So here's 24B, 13,414. So we'll plug that number in, and it's going to go ahead and auto-calculate for us. So we're going to move on to the 2017 figures, and we'll plug those into our form as well. So again, we're back up to line 31, 14,451. Line 12 and 13. Line 12's blank, line 13's 44,008. Line 30 is blank, so we're going to skip it. No casualty loss or amortization, so we'll skip that. And line 24B. 24B is 13,546. Now, you'll notice that the income calculator is going to auto-calculate based on if the income is declining, if it's stable, or if it's increasing. So we have a declining income situation here because of the depreciation. So the income calculator is automatically going to calculate based on worst case scenario, which would be a 12-month average off the current year. And then you'll get a little note down here that you have declining income. And then in the notes section, you would want to explain what's happening with the business. Why is it declining? If the income were increasing, let me change this 96,000 to 0 just so you can see what happens. Then you'll see the number of months calculated will go from 12 to 24 if the income is stable or increasing. You'll also notice that your little alert down here for the declining income will automatically go away. So let's go ahead and plug our actual figure back in here. So you would want to go ahead and add a note, what's happening with the business, why it's declining. You'd want to use that note section to communicate with your underwriter. And then the calculator is going to tell you the amount of income that you can use for qualifying. So how does that correlate to your 1003? So your 1003 in Encompass, again, you have to note who the income belongs to, borrower or co-borrower. And then I'm just going to do Schedule C 12-month average and go ahead and plug in the 3809. Now your underwriter is going to closely look at any declining income to see why is it declining and to try to determine if they can still use the income that you're trying to qualify with. Will the business be able to support that income? That's going to be the big question. But that's how you can use the Schedule C income worksheet. As you can see, it's very, very simple form to use. The next thing I'd like to show you is LoanBeam. You're going to run LoanBeam directly in FastTrack 360 through the Services tab. You'll go to Order Additional Services here. We'll wait for the pop-up. Here's our little additional services pop-up. If LoanBeam is not here in the My Providers tab, you can go to All Providers. These are alphabetical. You can locate LoanBeam here, highlight it, add to my list. When you click on that, it will then always be in your My Providers tab. You're going to click Submit. And then you'll have the LoanBeam pop up. You're going to add your income documentation into LoanBeam. LoanBeam will not auto pull them from Encompass or DocVelocity, so you are going to have to add them yourself. I suggest browsing from hard drive or your e-folder, wherever your documents are. In our example, we're going to go ahead and load 2 years worth of our tax returns, individual, corporate, and K1s. I'm going to highlight them all and hit open, and they're going to go ahead and load right into LoanBeam like so. I highly recommend splitting up your documents by year, like it's showing here. Split out your individual from your business returns and split your K1s out from your business returns as well. I also recommend removing any K1s that do not belong directly to your borrower. I have had it happen before where LoanBeam the results will be skewed because it will read K1 income information from someone that is not on the loan because the K1 is there. So again, I do recommend removing the K1s that do not belong to your borrower before you load them into LoanBeam. You can let the underwriter review them, but I wouldn't load them into LoanBeam. Once your documents are here, then you need to choose your output template. If you're using Fannie Mae DU, you're going to choose Form 1084. If you're using Freddie Mac LPA, you're going to choose Form 91. It's important that you choose the correct output template because Fannie and Freddie do have a different way of calculating income for partnership, corporate, and S Corp returns. It's also very important that you know ahead of time how many years worth of returns to load into LoanBeam before creating your order. For instance, if you are using Freddie Mac's LPA and you're hoping to achieve a 1-year tax return finding for a self-employed borrower, if that borrower's business meets those guidelines to be able to do a 12-month tax return finding, then you don't want to load 2 full years of tax returns if you're trying to go for a 1-year tax return finding, because LoanBeam will then calculate a 24-month average for you instead of 12 months. So it's very important that you know ahead of time which documents you need to load. Once you have your correct output template chosen, your documents loaded, you're going to click on the Create button here. The LoanBeam results take a couple of hours to come back. When they do come back, you'll get an email notification. Then you'll come into the Check Status View Results tab, and your results will be hanging out in here. Let's take a look at what some LoanBeam findings look like. Here's an example of a LoanBeam finding for corporation. Again, you'll notice it's set up exactly like the other income calculator that we were looking at earlier. It's an Excel spreadsheet. You have tabs across the bottom. So you need to know which type of income your borrower is so that you know which tab to go to. This one happened to be corporation. And it will go ahead and do all the calculating for you. And it will give you a qualifying income per month for the tax return. In this instance, $2,733. So if I go back to my 1003 page 2 for my co-borrower income, I can just type in corporation 24-month average and plug in the monthly amount that LoanBeam calculated for me. That would be the proper way to show that. I like to show self-employment income down here in the other income section. The reason I like to show it this way is because sometimes you will have a borrower that owns their own business and also pays themselves a wage. If they do that, then you'd want to put your wage earnings up here in base, just like you would for a regular wage earner. Just keep in mind that if your borrower owns their own company and they're paying themselves a wage, they are likely going to be subject to having to provide proof that they've been receiving wages for at least 2 years. And those wages are probably going to be averaged over 2 years unless it's declining. Then again, it's going to be underwriter discretion whether or not your borrower will be able to use that wage earning income for qualifying. And it'll be up to the underwriter to determine if the business can support the income going forward. Thank you for joining me today. I hope you found the session helpful. Have a great day.
Thank you for viewing this training. If you have any questions, please feel free to reach out to your regional processing trainer or supervisor.